Last year, WeWork was considered the most ridiculous attempted IPO of the year. However, for 2020, an already disastrous year for everybody, it appears that DoorDash might be taking that title. Oh my gosh, I can actually wear my DoorDash merchandise, my official DoorDash merchandise. How many times do I get to actually do that? Hey everyone, this is Kevin the Apptrepreneur, and yes, we are talking about DoorDash. We are going back to the root of the channel. I don't talk about DoorDash nearly that much, even though technically this started as a DoorDash channel, and some of those old how-to DoorDash videos still get hundreds of views a day, and frankly, have probably become my bread and butter at this point. But anyway, just because I started as a DoorDash channel does not mean I have any special love for this company. In fact, my relationship with them, as did with Uber, pretty much soured. Now, DoorDash is one of the last big gig companies to not file for a public offering, an IPO. Now, when Uber and Lyft did it, they did it because they frankly had no choice. They had run out of investment money. DoorDash decided to wait out a little bit longer. Maybe they were hoping for like a buyout of some sort. Turns out that didn't happen. Postmates was just recently bought by Uber. And DoorDash has now officially said, okay, it is time for us to file for an IPO. And it is being considered the most ridiculous IPO of 2020. Here's what Forbes has to say about this nonsense. Is it a coincidence that DoorDash, which is going to go under the ticker Dash, filed for its IPO so soon after vaccinations for COVID-19 were announced? I think DoorDash's current investors and bankers recognize that the window of opportunity to IPO this terrible business closes quickly when the threat of COVID-driven lockdowns no longer drives growth in food delivery demand. With the latest S-1 filed, DoorDash is aiming for a price range of $75 to $85.
Are you serious?
Oh yeah, no, please, folks. Look, I always have to say this, and it has to be real with you. This is not financial advice. I have to preface that it's not financial advice, but please, just my personal opinion. If you consider me an online friend of some sort, please do not buy DoorDash stock at $75 to $85. Maybe at $10 might be worth it, but don't. I would really not consider it. Anyway, at that price, this would give the firm a valuation of $23.8 billion to $27 billion, $25.4 billion midpoint. Such a valuation could be well above the firm's last private valuation of $16 billion. At a valuation of $25.4 billion, DoorDash earns an unattractive rating and would be the most ridiculous IPO of 2020. And we're going to read this article in detail, and I'm going to comment on his bullet points because I really want you to understand this. A lot of my viewers and a lot of my fellow Uber tubers foolishly bought Uber stock when they went public, and I felt kind of guilty for that because I should have made a video saying why you should not buy Uber stock, at least not right away. Now this is my video of me telling you why you should not buy DoorDash stock right away. So, I think this proposed public equity offering holds no value, $0 beyond bailing out private investors before unsuspecting public investors realize the business is not viable in its current form, which is funny. I've been saying a very similar thing about Uber for the longest time. This IPO reminds me of WeWork's attempted IPO, hey, there's WeWork again, which I called the most ridiculous IPO of 2019 because DoorDash's business is similarly disadvantaged. The fact that this company made it to the pre-IPO stage reflects the overblown fervor of the work-from-home theme. It's not a good idea to invest in businesses that have no moat, no profits in the best possible environment, which right now is COVID, and competition that can offer the same service for free. Basically, You're talking about your Domino's, your Panda Expresses, your Albertsons, your Raley's. All these companies are realizing that there's a future in delivery, and why have a middleman? Like, they can do it themselves. Worse yet, to justify a $25 billion valuation, the company needs to grow its share of global food delivery app market to 56% from 16% over the trailing 12 months, while also raising margins from 12% to 8% in an intensely competitive business. Basically, there's too much competition and not enough business to go around. Throw in the auditor's reports of weak internal controls, and investors could be holding stock in a business that might not be around in a few years. In all fairness, I thought that was going to be the case a few years ago myself, but then they ended up coming around anyway. So, here's the second part of his argument. Greater fool strategy looms large. I think the only chance for investors in this IPO to see any gain comes from a greater fool willing to pay a higher price for no economically justifiable reason. For that matter, the stupid money risk of a company overpaying for Dash to ride the work from home fad or follow Uber Eats strategy is real. Nevertheless, the ceiling for the price rational investors could pay for DoorDash is $1.4 billion, which equals $2.5 billion in capital the company has raised to date, less than the $1.1 billion in cash on its books. Why should anyone pay more than the cost to build the business? Especially when it hasn't come close to generating consistent profits and may never. Now, here's the important thing. And obviously, we've been talking about this on my channel for a very, very long time. Not profitable yet? Really? Yeah, he puts the really in there. It took a global pandemic to drive the firm's 1 quarter ended June 30th, 2020 of GAAP profitability. The firm has not been profitable since, and I think it may never be. The only firms with worse TTM net operating profit after tax, which is no patent margins, than DoorDash's are Uber and Lyft. Really? That's a... No comment. You know where I'm going with that one, though. If DoorDash can't do better than a 12% margin in this environment, perhaps the best possible environment for food delivery, then when will it ever be consistently profitable? Figure 1 compares TTM margins for United Parcel Service and FedEx, as well as Pizza Hut's parent company Yum Brands. Full disclosure, I invest in Yum. Domino's Pizza and Papa John's International. Full disclosure, I also invest in Papa John's. Figure 1, DoorDash's profitability versus peers. So, as you can see, here's the no pat margin. Yum Brands is at 24%. Can we make this a little bigger? We can make it bigger. So here's what it looks like. Yum Brands is 24%. Domino's is 14%. By the way, Domino's is probably the most expensive stock on this thing. It's like over $300. It's ridiculous how big Domino's is. UPS is 8%. FedEx is 4%. Papa John's is 4%. Grubhub is minus 5%. And DoorDash is minus 12%. By the way, Uber is less than 34% and Lyft is less than 57%. So that little boost that you got from the Prop 22 passing on the stock value, that sure ain't going to last very long. Anyway, so that's a pretty strong visual of what's bad with this. Now, low switching costs makes profits unlikely. The food delivery market is filled with competitors offering the same service, cheap food delivery. They deliver it at about the same speed. Without any other differentiating factors, switching costs are very low. Figure 2 demonstrates that consumers are increasingly exploiting the low switching costs. Second measure found that the percentage of DoorDash customers also using competitor services rose strongly since third quarter 19. So Grubhub rose 19%, Uber Eats rose 16%, Postmates rose 10%, and of course the funny thing, now Postmates is now part of Uber Eats, of course. But yeah, basically everyone just grew because it was like the circumstances. It wasn't because DoorDash did anything special. It was just the circumstances were right for people to want food delivered more and more. When accounting for customer overlap, second measures data reveals that the percentage of DoorDash customers who use DoorDash exclusively fell from 63% in the third quarter of 19 to 53% in the third quarter of 2020. With nearly half of customers using other services, it is clear switching costs are very low because they're basically nothing. DoorDash acknowledges the lack of differentiation and inability to retain customers without price incentives in its S1, where they wrote, this is from DoorDash, within our industry, the cost to switch between offerings is low. Consumers have a propensity to shift to the low-cost provider and could use more than one local logistics platform. Independent contractors who provide delivery services could use multiple platforms concurrently as they attempt to maximize earnings, and merchants could prefer to use the local logistics platform that offers the lowest commission rates and adopt more than one platform to maximize their volumes of orders, which basically means the flaw in this argument, of course, is that the drivers are the same for all these platforms. So you're going to get the same service regardless of what platform you're using. And basically the only competitive advantage anyone has from one another is to lower the price. And you get into this game where the companies are just lowering the price and no one's making any money. That's why this is not a good business model. You don't have to be a business expert to understand that businesses without differentiating offerings struggle to charge prices above the cost of the service. In other words, they never turn a profit. In fact, you know what? Let's talk about something that I think adds to this, which is movie theaters. And I'm going to bring something up here, and you will understand, because movie theaters are everywhere. They are everywhere. And I just wrote something down wrong. Sorry. And you would think that, hey, movie theaters have no competitive advantage over one another. They just don't. But that's not true, because there's actually several different types of movie theaters. Some movie theaters are just multiplexes, which are regular screens. And then you have an IMAX, which is a huge screen. Then you have independent second runs. You have the drive-in, definitely helpful during a pandemic. And AMC has their Dolby Cinema. And Cinemark has their XD screen, and they have different formats of 3D. The bottom line is, to someone who goes to movies a lot, you will go to certain theaters because they have certain experiences. Regal has the 40X, for example, and so there's advantages. But when it comes to these delivery services, there really is no differentiating between these services. You order the food, and you get it in the mail. And the only difference is how much the delivery fee is going to cost. So there's no advantage there. And that leads the rider to say, damned if you do, damned if you don't. Because the only competitive disadvantage that may be worse for DoorDash than low switching costs is competing with your suppliers. Before the standalone food delivery services entered the market, Pizza Hut's parent company Yum Brands, Domino's Pizza, and Papa John's International delivered food to customers for free. Now, most of the time, they charge for delivery, albeit at prices usually far below the pure play food delivery firms. The point is that these restaurants can offer delivery for a much lower price or even free because they have core businesses that generate profits. If DoorDash or any other pure play food delivery firm becomes meaningfully profitable, why wouldn't more food providers move into the delivery side of the business? When suppliers can take away your product because they want your profits, they usually do. Just ask MoviePass and what happened to them after AMC Stubs A-List launched. At least in competitive markets. Even if there are not large profits to be made in food delivery, the restaurants might still take it over in order to protect and control their relationships with consumers, which is one of the big hiccups that In-N-Out Burger have with these services. They do not like when Postmates or Uber Eats or DoorDash buys from them, because they can't control the quality of the food. Since most food delivery drivers get a fee that accounts for time, distance, and desirability of the delivery, they probably care more about maximizing the volume of deliveries rather than the quality of them. Yeah, this is actually true. I will not share what happened with my last Postmates order, but yeah, the guy basically left it on the curb, rang the doorbell, and walked away. And he didn't even put it on the box that said put food delivery here, just trying to get to the next order. Even if there are not large profits to be made in food delivery, the restaurants might still take it. Oh, sorry. Read that one already. Since consumers tend to blame the restaurant, not the drivers, for quality issues regardless of fault, drivers have less accountability for ensuring a good customer experience. Accordingly, restaurants may feel the need to deliver food themselves to protect the lifetime value of their customers, even if they cannot make money on the delivery service. Now, this is a pretty long article. I know and it's going to be extremely long. So you know what? We're going to actually stop this right here because this is going to be a two-parter, part 1 and part 2. So anyway, we're going to end that right there, but here's the bottom line. Please don't buy DoorDash stock. I would like to know what you think about what we discussed so far, and I will see you in part 2. Comment below, like, favorite, share, subscribe, and as always, flame responsibly. Merry Christmas.